So good morning, everybody. This is Dennis Warren with the Active Trend Traders. Those of you who have never traded through a downturn like this in the market, it is well, for lack of a better term, it is definitely exciting, but it's something you will never forget. And so the objective is during times like this is basically survival, and that's what we're after. Mike and his wife are traveling this weekend, so he won't be joining us. But he was with us on but he was with us on Wednesday night, and then he and I discussed what we should do as far as certain signals this morning, and we both agreed that it was time to the market is overdue for a bounce, and so we started applying and going to some partial positions in the early warning alert system. Gino makes a comment, Bill O'Neill was bullish on the market last week. How quickly things can change, right, Gino? So I want to remind everybody that what we do at Active Trend Trading, we do a lot of trading, and that this presentation is for training purposes only, and that any trader should always practice and paper trade any new method prior to risking their own personal capital. We love to teach. I love to teach and provide education opportunities for all of our members. And Wednesday night we've been talking a little bit about some of the things I picked up in the technical analysis seminar that I went to last week, that I'm trying to share just some new verbiage. It's not necessarily a new way of doing business, but it's just some new verbiage to give you some additional things to think about. This coming Wednesday night, we will be doing moving average refinements, continued, and the associated patterns with them, and what they tell us. When you look at a pattern, it's nice to be able to say, okay, here's what's going on with that pattern, where there's levels of demand, where there's levels of supply, when there's an equilibrium, because it can help us analyze where the market may go. Not a 100% guarantee of where it may go, but it's just a step in the right direction. So, and then for the premium members and the early alert members, of course, you can go there and watch the videos of those. We've streamlined the video page a little bit in that we have now segregated things into quarter by quarter, and so the most recent quarter will be up on the website, and then there will be links to the other quarters. That should help the videos process a lot quicker without getting the stops and starts. So where are we at with the market today? The big news basically is just worldwide weakness, and big question mark though, but is it time for a relief rally? It appears as if things are seeking lower levels of support, but it is definitely overcooked and over, as we see so many times. We will get an overshoot condition, and then we'll get a rebound back up into because the markets tend to, when they're do overreactions to any type of either good news and or bad news. And so S&P approaching the lows that would happen at the very first of the year. They're back down in that trading zone. We'll see what takes place from here. Nasdaq 100 at support after a hard down week, very hard down week. And then Russell at the first of the year support, and question mark on the Russell, is it time to bounce? Remember, the Russell has let us down, and so the question is will it now turn back around and provide a relief rally to potentially lead us back up? All things tend to hinge on what's going on with the Fed, and the Fed has had a lot to digest this week, and it seems like we have a mixed bag on whether or not they're going to raise interest rates in September or not. And so we'll see what goes on with that. Outside influences, primarily it's the global growth is a major concern. And what we're seeing in both China and Europe, is it contagious, and it appears to be passing on across to the U.S. markets to some extent. At some point, though, buyers are going to step back in and drive prices back up. We just don't know exactly when that is going to be and where that's going to be. So here's where we were last week. As you can see, with the stocks above their 20-day moving average on the NYSE, we were at just about 30, and we were talking last week about how it just seems like more and more of the stocks, or fewer and fewer of the stocks, are actually pushing up above their 20-day moving average, thus making the market heavy weighted towards the downside, and we're seeing a little bit of that, over the last few days. Here's where we had 9 o'clock this morning. Here's the reading for this week, 16.9. One of the things that Mike and I have been talking about, here's October of this past year. In October, we got a really nice bounce after things settled out a little bit, and there was a little bit of a fake out, but a really nice bounce from there that flung the market into a really nice rally. And we have been, usually we go with the 30% line, as that gives us it's not a trigger per se, but it's a time to say, okay, watch what's going on, see what's happening with the market, because there could very well be a turnaround very quickly. And what we've been saying is that we need more of a washout in the market, and when we get a total washout in the market, the number of stocks below their 20-day moving average, or above their 20-day moving average, excuse me, tend to get down here in the 15, 10, even 5, and sometimes lower. So we're seeing those lower levels penetrated today, and this is one of the reasons why we came out earlier today with an alert on our early warning system, in that saying, okay, we are really primed for a bounce, and like with any bounce, it can be challenging, pinpointing exactly where it's going to take place, and that's where we have to have a little flexibility in waiting for that bounce to take place. But we are definitely getting in a zone where we can anticipate a bounce. Now, because of the weakness in the market, our expectations on that bounce are not that great, and so we're looking at, on the leveraged index ETF, we're looking at maybe a 3, 4, 5%, bounce once we get the bounce, and so that's what we're looking at currently. And we're going to ride this one out, knowing that towards the end of typically the end of September, going into October, is when we also get additional bounces as the market sets up to run into its the end of the year. Dorothy asked the question, does the activity in the VIX mean anything? Dorothy, you've read my mind. We are going to be going to the VIX to talk about that in just a little bit when we start reviewing the charts. I want to remind everybody of, if you'll remember, a couple of weeks ago I showed this same strike, why the percent of the stocks above a particular moving average matter. And this was a snapshot of the internals of the market. In other words, the stocks were above their 200-day moving average on the NYSE back in 2007 going into 2008. And as we could see, things, were already melting down before the market actually rolled over and fell. And as we can see, here we are in 2015. This was as of mid-June, July or so, and we can see a similar, it's not the exact same thing, but like Mike likes to say, it's not the the same verse, but it certainly rhymes with what's going on, what happened up here. Now we're going to see a continued drop here. There will be some bounces because the market doesn't go straight down nor straight up, and so we could very well see some bounces in here along the S&P with a bounce back up. As of the S&P right now is right about 2,000. So from the time we first showed this, the price in the S&P now is down in this area. and it looks like it, should be primed for a little bit of a bounce. And so over the past couple of weeks since we've been showing this, the price of the S&P has continued to fall. Actually, it's done one of these where it kind of bounced here and then fell hard over the last couple of days. So that's one of the reasons why we keep an eye on this particular, this particular chart and these particular readings. And then it tends to be that when this percentage of stocks above a certain moving average get down into the very, very extreme levels, that is oftentimes the timing for the larger run-ups that we've seen, in the past few years. So as of this morning, about 9 o'clock, we took a snapshot of what the market's doing. The Dow has continued to fall from where it was last week. The S&P is now in negative territory also. The Nasdaq is holding on, but as you can see, from last week to this week, Nasdaq is down 5%. Matter of fact, if you lay and we'll take a look at that on the Nasdaq. The Nasdaq has almost corrected like close to 10%, and so we will see how, if that continues. And then the Russell, which was up slightly last week, is now down almost 4%. Are we getting the correction we're looking for? That's always a great question. Let's take a look over here at the charts. Let's start with the S&P. What is the S&P telling us? Well, a couple of things. The weekly chart on the right-hand side shows us that, one, we are in extreme conditions on the TSI. Typically on the weekly TSI, when this gets down in the negative 20, negative 22, negative 20 to negative 30 area, that is the prerequisite, or typically we will get a rebound back from that in the short term. And so as we can see from a weekly chart, we were up here sitting and prices were bouncing between the 2100 down to the 2050 level, and then that 2050 level broke. And as we were saying earlier this week, that if that level breaks, then we may very well get back down here and test the lows from the beginning of the year, which were right here, down about the 1984 area, 1983 area, and clearly we are down in that area. But we've had 1, 2, 3 significant down days on the S&P over here on the daily chart now, and we are in the support zone where we could anticipate a potential bounce. What kind of a bounce would be something reasonable? Well, a couple of things we can look at. One is you can lay in a horizontal trend line across there, and of course we can't see this on this other line, but it goes across here like this, where the previous, where it found support to bounce off of earlier. That could be a good area. Or we could also look at, just take this move from here to here and find out where the Fibonacci's lay out, where they show themselves. So get rid of that. Let me go over here. And I'll do a couple of things here. I'm going to lay in a Fibonacci first. So from this high to that low, that would show us that, isn't that interesting? A 38% retracement of this fall would take us right back up to the lower portion of this at the 2045 level. Is that something that's reasonable? Yeah, sure it is. Because as we know that, by Dow theory, that typically a move in either direction will tend to retrace somewhere between 30 to 60%, and that would be at the lower level of that potential retracement. How much has the S&P now corrected since its high back here in May? To today's low, we've got a 6.7% correction. That's basically the biggest correction that we have had on the S&P That is the biggest correction we have had on the S&P for well over a year. Another thing of keep in mind is this fall, this drop right here, that is the largest drop that we have had in quite some time on the this is 2013, 2014. So it's the biggest fall that we've had in approximately 2 years. Oftentimes that can be a prerequisite to more significant falls, but it could be showing and reflecting a definite change of character for the S&P. Gary asked a question for the SPY 1990. That is probably a good support level. Let's take a look at, here's the spiders. And so if we were to draw the same type of thing, you're looking at about 197 for support level. That coincides with that on the S&P. Nasdaq. Nasdaq was holding up quite well earlier in the week, but as we can see, once it did start to fall, again, similar item here is that this week's correction is the largest and most significant that's been there for the last several weeks. So what does that tell us? I mean, again, it could be reflecting a definite change of character. We've been talking a lot about this rounding top that's been going on up here, and it could be that rounding top coming into fruition. And what can we expect to see how we can see that work out? If prices close below this 42.45 level, if they close below this like I said, 42.85 level, well, where's our anticipated place where it will go? Well, we have dropped the 100 already, but we are extended away from the other moving average. So at some point, it's going to want to rebound, but it could reestablish. Once it closes, we basically could drop back here to the lows at the beginning of the year, and it could just reestablish a new horizontal trend that would go like that, and that could continue on for several months. And then, with demand here at the bottom and supply here at the top, and right now there has been not a lot of demand for the supply that's been provided by the on the indices. And we're seeing also that gravity is taking over where those, where the bigger portions of the stocks on the NYC and also the other indices, the vast majority of them are already in a, basically a significant correction. And now what we're seeing is a little bit of a meltdown with the leaders. And it's, it's very, very typical. Let's take a look at the Russell. Not okay. The Russell is leading the way to the downside, and it's been in a very nice, nice little downward trending, short-term downtrend going on for quite some time. And so what we're seeing here is we're finding strong support, and this was support at the very beginning of the year, right here at the 1151 level, and our 1152 level, and so we're seeing a attempt to bounce there, and so the buyers are coming in just a little bit, and they're still not effectively pushing the price back up yet, but certainly we're in a level at a level for where we'd anticipate some sort of relief rally. This chart demonstrates, and I just want to show everybody, this chart demonstrates something very well. As the Russell started to correct back here in the June time frame, there we go. As it started correcting back here in the June time frame, it came up and made a lower low, our lower high right here, and then it dropped back down. And actually, this level here is within, within a trend channel. But as it rebounded off the 200-day moving average this time back in mid-July, notice how it rebounded, but it failed to close the gap enough up to the trend line. And so this is an acceleration to the downside. Did the same thing here, gaps getting a little bit larger until finally it fell out of bed this past week. And what's very interesting, let me throw on this trend line. What's very interesting, and so that's a classic kind of acceleration to the downside, and it shows how a stock can, here's our primary trend up here, but we can go back to this high, connect these other highs, and look how on Monday of this week the prices pushed back up to this low, accelerated trend line, but then reversed down off of that and fell like a rock. And so Gary asked the question, is capitulation an event or a process? Gary, typically it's looked at as being more or less an event. In other words, you get this huge down day. I think the Russell back in October, or actually the S&P and or spiders show a better picture of this last October. Let me see how it shows up on the S&P. And if not, we'll take a look at the spiders. Yeah, now it looks really good right here. Okay, we get this huge down move on the spiders on back in October of last year, and then you get this candlestick right here, which shows it drives hard down to the support of the trend line, and then reverses and pops back up. So that week would be looked at as being a capitulation week. So in that way, you could look at it being a process. But let's scoot back here on the daily chart to that time period. Yeah, let me move up a little bit. And so what we see working out, I think this is last October. No, it's not last October. Go forward a little bit. And you can see it on a daily chart here, is that we get this hard selling off, hard sell off, hard sell off, hard sell off, and you get this one candle right here, and that was on the 15th of October last year. That's the capitulation day where it drives itself hard down. It would have basically opened here, drove hard down, sell off, sell off, sell off, and then rebounded to put in that hammer. And so that's a very good picture of a capitulation day when that basically reset the market. And that's what we're waiting to happen right now. And as we look here on the weekly chart on the S&P, we're getting this hard drive down. Now this could, in fact, drive back up here to the 40-week moving average, and then drive back down into here. But we're looking for that type of capitulation where you get a hard drive down and where it's very clear on your chart there was a change of character in that entity at that point. So, okay, any questions on the markets, guys? How many of you have actually traded a significant market correction yet in your trading career? Are you going to show me your hands? Okay, Gary, good. Mike, Michael, and Richard. Yeah, it's the first time you go through it, it can be very frustrating because you want to trade, but but at the same time, things are really kind of freaky out there, and you get a lot of whipsaw. Your win-loss ratio and the number of winning trades to losing trade can get all out of kilter. And so when the market kind of turns like this, if I can hit, like my objective is to hit 60%, but if I can hit even 50%, that's good for a market like this. Dorothy brought up the question about the VIX. It's the volatility index on the S&P. And as we can see, I want you to take a look at this on the daily basis. Here it is. We basically launched out of here, and this is where the market collapsed the last few days. And typically when the market turns bearish, that is when volatility starts to spike up. Well, on a daily chart, we see, hey, we've got really high volatility now, but what's going to happen now? Is this the question, you talk about thing, is this an exhaustion gap to the upside for volatility, or is volatility going to increase and go higher? Click this across. Yeah, I'll leave. There we go. What we're seeing on a weekly chart now, and I've expanded, let me get that, see if I can get that a little clearer. There we go. This last week, we've had a spike in volatility all the way from down here at about 13 all the way up to 24. Well, what does that, what does that reflect for us? What do we have going on here at 24? Well, we know that here's a high. And typically, when they've went over these highs on a weekly basis, and here is a high back here at 27.82, that there tends to be a reversal very quickly after that. So we're getting up into that range, up into here, where one would anticipate the volatility would in fact when we would anticipate that some kind of a reversal. And the challenging thing sometimes is waiting for that gosh darn reversal. That's a tough one. But that's where you find the levels of support, you find the strong support, and then start nibbling a little bit. You're not going to go push all your chips onto the table, but it's certainly okay to start nibbling just a little bit. Because a reversal is typically in hand. Now there are times where, let me slide across here. Let's go back here and look at the 2000. This is 2011, where we peaked even higher, up at 45%. For option traders, that's a place where you want to be selling options rather than necessarily buying them. Let's look what happens in. As you can see here, we had a climb in the volatility back in 2000. This is 2007. We had a climb in volatility, and then it basically leveled off for a while in 2008, then shot up significantly. This was the low in 2008, and then the market started climbing from there. But look, in reality, it can get quite high, and so just because it's above 20 doesn't necessarily mean that it can't go higher, because in reality, if we go into a severe market correction, anticipate volatility going a little bit higher. But at this particular point in time, get rid of that. At this particular point in time, it looks like it's getting a little bit overcooked to the upside and might be ready to do a little bit of a reversal. We'll have to wait. On the weekly chart, it doesn't look like there's looking like a hard reversal yet, but that's why I'll keep my eye over here. If we finish down more towards the 21 today, or even at the low of the body today at 22.55, and the price on the indexes start to reverse and come up very good, that will provide us at least a little confirmation that we made the right call on the early warning alert system. Let me see if there's any other questions. Good question, Gary. And Gary, you had asked that we put out, that I put out some charts with some support lines on it. I did that last night in the market update. I hope that was what you were basically looking for, where I was identifying the sound. Okay, cool. The strong levels of support. So let's go on to back to here. So how are we surviving the wake? Of course, the active trend trading system. What to trade IBD quality growth stocks and the index ETFs, when to enter, when to exit, what strategies to use, what to expect. As we've seen this year, we've suffered a lot of whipsaw this year, without a doubt. We were up to about $4,000, so we lost about $800 this past week, which is, given the volatility of the market, I'm not unhappy with that. We've talked about this previously, about the trading system and then attaching the strategies to the trading system and function off the trading system for that. The S&P, here is the one of the option trades that I do, the wealth and income, and here's where I'm sitting with my trade on the spiders. Is something I'm doing. I own the long-term spider January 2017 210 put. I bought it for $21 with the anticipation that the market was going to correct sometime over the next 18 months or so. We may be seeing a little bit of that now. And so what I try to do is I try to time my puts on it, and I'll sell puts against it for the income, and also to reduce my cost basis. And right now my cost basis is down about $12.57. And this particular option is running right now at about $20. And so, and then what else we got going here? I didn't get to this slide. Strategy one, we did have one strategy, one trade on Celgene was stopped out. Strategy two also got stopped out on Celgene. And wealth and income generating, we're up in our calls, a little bit down in our puts, and we're going to be getting ready to roll the puts going forward. We do have a triggered early alert warning right now, and we entered a trade on UPRO earlier this morning. And just a real quick for the folks who join us via the YouTube channel, for anybody who watches, we do offer a discount for our membership. So for me, and on behalf of Mike, hey, thanks for joining today. Keep the egg growing. It's a great time. Keep your powder dry. There will be a time, and in the not too distant future, where we can anticipate starting to move into longer trades. And at this point, what I'm looking for is, since the significance of the downtrend has taken off, I'm going to be looking at prices popping back up to a level of resistance and looking for short trades from there. As we saw, there was a lot of damage done in a lot of stocks this week. And so again, thanks for joining, folks. We'll see you next week. Have a great weekend, and God bless. So let's take a look at some stocks. Oops, not that chart. There we go. So we've got a couple here. Dorothy has a question. Michael, this correction has been hard to play so far, as volatility was too small at the beginning. Yeah, Michael, you're absolutely right. Michael's making a point, is that the volatility just sprung out, really hard, and so it wasn't a gradual buildup. And he says the option writing did not really work well so far, except for GLD, for gold. Dorothy, would this close today be time to redraw the trend channel, or do you expect it to go back in the lines? A lot of times I'll leave the trend channels in place to see if it does in fact go back through the lines. And so, and then Tracy is saying, if Cyber was good at 55, it must be really good now. Yeah, Cyber took a real dump. There was a lot of things that were just, baby was being thrown out with the bathwater. And so Tamsin, let's see, I assume that I should just put a conditional to sell the IWM put this week for next week at prior to close of market. Yeah, I'm going to be basically closing out the one. I'm looking to see on the IWM trade. I'm looking to see what kind of strength we're going to get going into the end of the day. Because what I'll probably do is I'll probably roll the existing put into a similar put for next week, and which I should get a higher premium on that. So let's see. One of the things I am looking at doing, folks, is Tesla. Here's my logic behind Tesla. First, I don't put a lot of credence necessarily on what the analysts say, but considering that Tesla, it's fallen back down here to a level of support at around 234 or so, it would be very interesting over the projected price of Tesla by Morgan Stanley was placed at $465. Now, looking at this and going in and looking at the January 2017 calls, and at the money call, will cost you, about $21, $22 or so, maybe a little bit more than that, and with a pretty tremendous upside for it. And the premium that can be sold on the Tesla position is pretty significant. It has fairly high volatility. The downside is typically because of the volatility, oftentimes the value of the call you sell doesn't fall off until like the Wednesday, Thursday of the following week. But something to at least keep an eye on. It's like I said, it's looking right now. It's looking like it may want to track further down. Track further down. It's in a downtrending channel, but if it stops here, that tells us that demand has come in on this stock at this level, at somewhere right here about 233 to this level up here at somewhere in that range. And if it pops back up, it could very easily run significantly higher. And so I wouldn't go big, like I would do one or two contracts and that's it. And then do what I'm doing with the spiders and the IWM. I would just look at the proper point to sell premium against it. Anyway, that's a thought that I've been chewing over the last several days. So Gino wants to look at DHI. DHI's. Yeah, DHI. DHI and its cousin Lennar. Lennar was brought onto the IBD leaderboard this past week, and look at Lennar here. It's broken back down. It broke out, has fallen back down, but now it's looking like it's trying to push back up. And let me go back to the one you want to look at though, DHI. Again, it looks like it was a little bit more advanced than the Lennar. It had a breakout here at about 29, and now it is pulling back to see what it's going to do with that breakout. And so I would wait for the breakout. If you're already long, you're going to want to keep some protection because it is extended away from its moving average. Here's the 20. Here's the 5, and so ideally I would be looking at this to do a little bit of a pullback. I wouldn't expect it to go much below 30 or 29.50, but that might be a really great place for a trigger into the trade. Okay, what else you got there, Gino? NXPI, excuse me. Okay, NXPI is coming off a real hard, huge downturn. What have we found with NXPI? Where is it stopping at? Well, it had a strong level of support here based on that previous breakout level, and it's stopping there. We'd like to see it do a little bit more constructive here before it rebounds, but this could rebound very easily and get back up here to the 85, 86 level, which is back at this particular swing low. So that is kind of the now one. If somebody's going to do a shakeout type trade, you'd want it to break back above the 85.65 level and continued on up. But then you would, if you took an 85.65 trade on this or 85.70 trade, you'd want to make sure your stop was pretty close, like in the 85 area. Let's see, Gino, what else you got? Okay, Skyworks. Skyworks is clearly in a downtrending channel, but it's at the lower portion of the channel. It is running into support here at the 80 level, which kind of coincides to where it broke it over here. It found support earlier in the year. There's another level of support down here at the $75 level. And so based on today's candle, this week's candle, okay, this is a significant down week. And so we'd be looking at, we wouldn't want it to fall much more below where it's at for a potential rebound. But it has been a long-term uptrend, short-term downtrend. And so this is a nice little pullback, and let's see if it goes into a consolidation of accumulation or a consolidation of distribution. So Tracy, you like cyber, huh? Now let's see what cyber's doing. What has cyber done? This 55 low was looking like a really good level of support. However, it broke that. Now where's cyber gone? It's gone down to the next level of support at the 50 level, and we see that today. This is the 200-day moving average. The 100-day moving average is up here. And so the 50 hasn't crossed the 100 yet, but I wouldn't necessarily take cyber off my list simply because at some point, if it can make its way back above the 200 and the market gets in gear, that could be definitely a nice little trade, and it's got a wide enough range that you can trade it from support to resistance and back and forth. Let's see here. Dorothy likes Disney. Let's see, Disney is showing support from a gap up. It is. Oh, the gap up in February, that would be back over here. Let me expand this just a little bit. This gap up, okay. What's going on here is whenever you get a gap up like this, the midsection of the gap can oftentimes be very significant level of support, and it seems like that's what Disney's finding right now. At the same time, it is very oversold, and if I draw in this, it's got really strong support at the breakout level, and look where it went. Right square dab to the support defined by this particular candle on a weekly basis. And so, again, you're going to want to wait to see some strength. And, the strength may be coming into, if you're looking at trading Disney long, the strength may be showing up right now. We shall see. Okay. Star Wars is coming, okay. XBI. And the question XBI, Let's see. It's a biotech, okay. Interesting. Yeah, I would be watching what's going on with this one right here, because basically we can draw this. This is an area of support, or a support zone, and it runs from about 200 right there, 200 up to 210. Is it basically pausing or setting up for a potential consolidation across here and then a possible move higher? Again, this area of, it's going to all depend. If this area of consolidation that it moves into, if it moves into that area, will it be a area of accumulation or distribution? And if it's accumulation, we can expect a break out the top. If it's distribution, we can expect a break back down. And where might it go if it breaks back down? Well, it could actually drop all the way back down here to the 180 level. We're getting a nice candle on a daily basis, and so we know we've got strong support down there at the 210 level. Kind of interesting. And we're also getting some good volume coming back in, since the day's not even over and we're getting that kind of volume coming back in. That's a good thing. So GILD. Yeah, the biotechs are really, we did an earlier trade this week in Celgene. The biotechs are just, they're not selling off quite as strongly as the market, but they have been hit this week fairly significantly. So what are we seeing here on Gilead? Okay, this breakout area, which was at the 212 level, there has been broken. So we'll lay that in there. It tested it yesterday and has now fallen below it. Is this a and then what are we seeing here? This reaction from here down to here, that looks to be about the strongest it's had, or close to it. So we'd want to watch this to see if it starts forming a new base in this area to launch back up. So because if it goes into doing a consolidation area here, we'll be watching the volume to see what, does it appear as if more buying is coming in, or is it more selling? And right now, because this is that, like here is let me give a demonstration of this. Okay, here was we had a nice run up to the high, and then it fell back in, and then we started a consolidation. At this point, it drops below the consolidation, but then springboards back up through the consolidated lower resistance support line on earnings, pops all the way up here on earnings, but it bumps its head immediately back up against the support line and then starts selling off. What is the volume telling us? Well, as we start these sell-offs, as we can see, the volume on the sell-offs, not huge. It's certainly not spiking, but except today we do get a nice spike in volume. But it's certainly not spiking, not huge. However, when the distribution starts here, those two red volume lines there, they are larger than the buying volume going across. And then over the last couple of days, we've seen a pickup in selling volume, which tells us that somebody's getting rid of the shares. And oftentimes that often happens with the institutions, is they hit their price target and then they basically need to start peeling out of the position little bit by little bit, and at some point the retail investor gets wind of that, and then they jump on board. But in this case, this may be jumping on board simply because just the market downside. IWM leading now. It is over its 30-minute high. Great. Yeah, okay, cool. Yeah, IWM is in fact jumping back up. Get a picture of that. And so these old lows has in fact held. Let's see if how significant this push-up is. If we can push up more than halfway of this candle, that could be significant. So that long tail, as we see over here, could be saying that, okay, IWM's not going down for a while. It's going to roll back up, which is a good thing. So, okay, any more stocks, guys? Okay, those of you who have been doing strategy 3 with us, I will be pulling together all the information on how things have gone. Did I miss SBLK? I did. Sorry about that. Spelunk. As I was going to say, I'll be pulling together in first part of next week, hopefully shooting for Monday to send out, okay, here's exactly how this trade has been rolling since we opened the long leaps, the call and the put side on the IWM. Okay, what are we getting? Here was a capitulation move to the downside on SPL right before, on Splunk, right before earnings. So that's telling us that either somebody knows something that's coming out on earnings, and so they're just getting rid of shares now. We've got earnings coming up on the 27th, which is next Thursday after hours. And so at this particular point, I wouldn't necessarily, I wouldn't be wanting to jump over so I wouldn't be jumping on this right now. I'd wait till after earnings to see what takes place. We've got, nice little build up here. This has some really nice range. I don't know what kind of volume it does. And I would have to, to see if it's a quality stock, I'd have to run the IBD stock checkup on it. But I like the patterns. It puts in very nice patterns, and I do find it a little bit concerning that it has now rolled below its 50, 20, 100, and 200 day. But again, that could be just a precursor set up for pre-earnings, and which if earnings disappoint, it could continue on down. Where might it go? Well, you've got your 57, and then also down here at about 51. Cyber. Okay, Judy, yeah, Cyber gap down today after selling off. It stopped right, and this is one of the reasons why I do not like to take trades just specifically at a support level when prices stop there, because as you can see, this is a huge bearish candle. And so, yeah, one could have taken a trade yesterday at what was low, 55.07. And then we would have been kicking ourselves in the rear all day because there was no recovery off of this 55 level, none whatsoever. And so it's oftentimes much better to wait for the recovery, especially after a significant bearish candle appears. And here we have now a bounce at a lower level of support. And so it may start ricocheting back here a little bit. And so right now, Cyber is on my watch list for a potential trade, but until it proves itself, because now it's moved this trading range that was between just about 63, this trading range here, from 63 down to 55, and it has moved it down. And so now it could potentially just start operating the same thing where it would bounce up here, resistance, support, because it tends to like to move in those $5 to $6 to $7 ranges. Facebook. Cool Wender, do you really want me to do Facebook? Nah, just kidding. And I'll come back to initial coverage. I missed it, is now in 16%, well below the 30. Does this tell us anything about jumping? It tells us that we are getting, that you're talking about the percentage of stocks above their 20-day moving average. It does tell us that it appears as if we're getting close to where we can anticipate a turnaround. And for the early warning alert, guys, we did send out that alert this morning. I talk with Mike, and Mike says, it's time. Oh, yeah, look at that. Isn't that great? It went right back to its support level. Now, some brave souls will say, you know, I'm going to go ahead and gamble and take this trade here because it is bouncing off support. And sometimes you're rewarded on that, sometimes you're not. But look what's happened. We've had, you know, sell-off. We had a big sell-off day back here. And if you just go back over the last few months, the largest volume has been on a down day, or a basically do nothing. But that was a hammer, so that really doesn't count. That's why it's always important to look at your volume in context of what the candlestick is. So that one really doesn't count. We get the drop with the market right back down to a level of support, and it's bounced back above the 100. Yeah, I wouldn't want to jump on Facebook immediately. Let's see what it's going to try to, let's see what it'll do with the market, and then move from there. Good call. Yay. Electronic Arts. Again, big sell-off last few days. Significantly drops the 50-day moving average. And there's a couple of ways that these can be traded. It is bouncing off of a, isn't that amazing how that works? As we go over here, when you see something stopping in midair, always go back to your left. And if you can't see far enough, go back further to the left, and look where that stops, right at a breakout area, which is defined by that little tight pattern right there, which IBD would have called this a four-week tight pattern, and then bam, it flew up. So it's held. That's great. Support has held there, but now the big question is will we get something constructive here, showing us they're going to move back up into the upward area. Oftentimes, when we get a drop of the 50 on significantly high volume, that is a signal that this stock should be looked at for potential shorts going forward, or until it does a consolidation here to move back up. On early warning lines, do I count 20 trading days or put in for a profit point? Yeah, Dorothy, on the particular, when I sent out the alerts today, slight difference because of the fluctuation in the market. Mike and I are basically going to do some target shooting on this one. So if it gets back up to the, it was in the email that went out, the specific of where we're going to be taking profit. And it looks like we're getting a little bit of rebound. This is a good thing. So with that, folks, I'm going to call it a day. Thanks, you all. Please don't hesitate to share the email I send out with notifications of the Friday show. Please feel free. The more the merrier, and I love answering questions. I love doing technical analysis, as you all know. So have a great weekend, and stay cool or stay warm.